Today's market update is going to be a fairly brief one. I don't have very much to add to what I said in last week's market update, but the S&P 500 is at a very interesting juncture, and so I thought that we would discuss that today. It is the 31st of January 2022. My name is David Hickson, and as always, I must ask you to please make sure that you have read and understood these disclaimers before we take a look at the markets. So we're looking at the S&P 500, as I mentioned. I'm not going to be repeating everything that I said in last week's market update. I'm trying to keep these market updates short and sweet. And so if you don't understand the bigger picture in terms of what I'm discussing here, I would encourage you to go back and take a look at the previous market updates. There will be a link to those in the description beneath this video. So, as discussed in last week's market update, we are looking at a situation where the 18-month cycle trough formed at the beginning of October. You will know if you look at previous market updates that there are various possibilities for that 18-month cycle. But in terms of today's discussion, we're going to be focusing on that position for the 18-month cycle trough. And I'm going to spend just a few minutes taking a look at a very interesting alternate possibility that has been raised this week by some comments in our YouTube channel. And so we're going to be taking a look at that in a moment. But for the purposes of today's discussion, we are focusing on the 18-month cycle trough as having occurred at the beginning of October. Now, an interesting thing happens when you are performing a cycle analysis. Some people get very attached to the exact magnitude of a particular cycle trough. I tend not to get too attached to it because of the multiple cycles that are active in the markets at any one time. Let me demonstrate to you what I mean by that. If we measure the number of bars from this October trough to this 80-day cycle trough that has been positioned here at the beginning of December, you can see that 63 days elapsed. Now, if for a moment we disregard the magnitude of this trough over here, all that we know is that a fairly big magnitude trough formed. In our opinion, or I should say in my opinion, it is a trough of at least 80-day magnitude. Why? Because 64 days later, another trough formed, which was therefore probably also of 80-day magnitude at least. And it was a less important trough than this trough over here. Therefore, this trough would have been not only a trough of the 80-day cycle, but probably also at least a trough of the 20-week cycle. Could it have been a trough of the 18-month cycle? Yes, I believe so, and we'll step back in a moment and I'll explain in a little more detail exactly why I think it was probably a trough of the 18-month cycle. But in terms of the amount of chart that we're looking at here, and sometimes it's quite important just to zoom in and not worry too much about the longer cycles, just focus on what is happening on a shorter time frame. And so that's what we're doing here, and we can see a very nice clear cycle picture that has formed. It has formed a very beautiful M shape, and so here we have an M-shaped cycle. It's a bit of a wobbly cycle, but I think you can see what I'm saying. We have very clear evidence of cycles active in this market. As I've just mentioned, this trough in October was of at least 20-week magnitude because of the fact that a less prominent trough formed 64 days later. The average length of an 80-day cycle, I should remind you, is 68 days, and so that was only 4 days early. And so that is a very good candidate for an 80-day cycle trough. Now, of course, price is moving down and we have a bar count over here. You can see that 59 days have elapsed as of today. And so last week, Monday, when this trough formed over here, that would have been an amount of 52 days. Now, the average length of an 80-day cycle, as I've already mentioned, is 68 days. So that was about 16 days early for an 80-day cycle trough. I discussed this in last week's market update. I mentioned the fact that we were still looking at some time elapsing before the formation of this 20-week cycle trough. Now, here you can see it has been phased as being a trough of at least 20 weeks. That is because of the fact that this trough here in October is a trough of 18-month magnitude. And so therefore, following an 80-day cycle trough in December, the next trough that should form is, of course, the 20-week cycle trough. And if you don't understand the way in which these cycles fit together, and the different wavelengths that I'm speaking about, and the fact that an 80-day cycle is only 68 days in length, I should encourage you to download the 10 core concepts document, which will be in the description below this video, which explains some of these core concepts, of course, and explains what it is that I'm speaking about here. So because we have an 18-month cycle trough probably here in October, we expect this trough to be of 20-week magnitude. But as I've mentioned, we could actually ignore the magnitude of this trough, and by the process of deduction, we know that this is a trough of at least 20-week magnitude, as I've already mentioned, and therefore this next trough here must be of at least 20-week magnitude. It could be even greater magnitude, and it could be a potentially much longer cycle that is forming a trough here. We can take a look at that in a moment. But the important thing is that a trough of at least 20-week magnitude is forming now. So how do we approach this? Is it possible that this trough over here that formed last Monday is indeed the trough that we are waiting for? It is just possible. Do you notice these circles and whiskers here at the foot of the chart? Here are the circles, and the whiskers are the lines to each side. The circles represent the exact time that the next trough of each particular cycle is expected to form. And you can see that these circles form a bit of a vertical line there. And so this is when the next cycle trough is expected to form of the 20-week cycle and all shorter cycles, because of the principle of synchronicity. They are, of course, synchronized. And so that's in about the middle of February. So still about 2 weeks away. And if you look at these bar counts, of course, we have 59 days there. So we're looking at another 9 days to achieve the average wavelength of an 80-day cycle. And here we have 122 days, and the average length of a 20-week cycle is 136 days. So we're looking at another 14 days there. So our expectation is that the trough still lies ahead of us. However, is it possible that the trough has formed? It is just possible because of the fact that this whisker, or this line, is extending over this period of time. This line represents the reasonable range of time within which a particular cycle trough could form. So it's very important to pay attention to these lines, these whiskers, because they represent the range of time in which a trough could reasonably form. So it is just possible that this cycle trough did form last week Monday. So what do we need to do? Should we be jumping into the market? Well, I would discourage that, because we are not absolutely certain yet that that trough has formed. What do we need to see happen? I am now going to display my favorite tool, the FLD, the future line of demarcation. You know that we use the future line of demarcation to track a sequence of interactions between price and the FLD. And that helps to assist us in assessing the analysis that we have in our charts, and also in terms of making trading decisions. Now, as mentioned in last week's market update video, we had price crossing down below this FLD, which could just possibly have been an F category interaction. Then it came up and found resistance there, which could just possibly have been a GH category interaction. I discussed in last week's market update video that that might be a little premature. But in terms of this possibility, that means that the trough could potentially have formed here. And then the next interaction that we're going to see is price crossing up above the 20-day FLD in an A category interaction, where we will see price bouncing out of the 20-week cycle trough, and it will then be clear to us that the cycle trough, the 20-week cycle trough, has formed early. So why do I say that we are at a critical juncture? Because the other possibility was that this was only a D category interaction. I would encourage you to go back and look at last week's video just to remind yourself of those details, which meant that the E category interaction failed to get above the FLD. An unusual circumstance, doesn't happen very often, but it is certainly possible, which means that then the F category interaction is as price moves away down below. The sequence of interactions is not nearly as good to look at. It's not nearly as fitting in terms of the sequence of interactions that we normally follow, but it's by no means impossible. The danger of this is that then price will come up and find resistance at the level of the FLD, which would then be a G category interaction, and we will see one more move down into this 20-week cycle trough. And that is why we are at a critical juncture. As you can see, the FLD over the course of this week is dropping down sharply, and price must now show us what it is going to do. Is it going to find resistance at the level of this FLD and then move down, indicating that the 20-week cycle trough still lies ahead of us, or is it going to cross above the FLD and therefore demonstrate that the 20-week cycle trough has formed in the markets? It is for this reason that I find the A category trade often quite difficult to actually trade, because when you have a potential premature trough, an early trough forming in the markets, it can be quite risky to jump into a long trade as price bounces out of it and touches the FLD, because we might still see resistance forming at the FLD. For this reason, I often skip entering into the A category trade. A much more reliable trade to enter into is after price has crossed above the FLD, you wait for it to come back down to the level of the FLD in a B and then C category trade, and that often provides a better, safer entry opportunity into this trade. So that is the critical juncture that we're at the moment. The S&P 500 and of course many other stock markets need to show us what they're going to do. Are they going to bounce out of a trough that formed last week? It would have been an early trough, but not impossibly early. Or are they going to come down for one more go at the 20-week cycle trough? Now, I've mentioned a few times that there are other possibilities in terms of the trough that's forming now, and there were some interesting comments on last week's video about the possibility that the trough that's forming now is only an 18-month cycle trough. I've been watching this analysis for some time. I've hesitated to show it because many Hurst analysts, dare I say most Hurst analysts, would definitely question the possibility that an 18-month cycle trough is only forming now, because of the fact that there have been 672 days that have elapsed since the March 2020 trough. That is way too long, most analysts would agree, for an 18-month cycle trough, or an 18-month cycle. The average length of an 18-month cycle is 546 days. 672 days is really too long. Okay, so the possibility that an 18-month cycle trough is only forming now is not very high. However, it would certainly go some distance towards explaining why the market has moved down so strongly over the past several weeks to form this trough. Because in our other analysis, of course, the 18-month cycle trough is positioned over here, and then here we have a 20-week cycle trough, and this first 20-week cycle trough should usually form above the level of the 18-month cycle trough that preceded it. As you can see, price came right down and tapped that level, ever so slightly pushed below it in most markets, and might potentially now be bouncing up again. So is this a possibility? I'm showing you this chart because of a particularly interesting comment left by Sid Norris. Quick shout out to Sid, who is from Elliott Wave Plus and combines Hurst cycles and Elliott analysis. He is a very experienced Hurst analyst, and he pointed out something very, very interesting in a comment to last week's video, which has to do with the fact that the March 2020 trough, the very big trough that we've been speaking about for some time, and let me just zoom out, here we go, occurred early. And if you go back and take a look at the market update videos that I was recording at this time, I was only expecting the 18-month cycle trough and the 54-month cycle trough to form, I think it was in about June of that year, and so that trough definitely occurred early. Troughs do occur early, it sometimes happens. Sid pointed out that if we measure the distance from the 18-month cycle trough that formed in December of 2018 up until the trough of last week, we come up with 37 months, or 1,127 days according to this chart. And of course 37 months is equal to 18 and a half months. And so it is in fact possible that because of the fundamental interaction of the pandemic, which of course pushed markets down initially, I shouldn't say of course, but which possibly pushed down markets a little earlier than they were expected to go down, and the fundamental interaction of the pandemic and all the news that was happening at that time could quite possibly have caused that 18-month and 54-month cycle trough to have formed early. And so what we have in fact seen happening since the December 2018 trough is in fact 2 times 18 months. So that is a really interesting idea, and I'm just relaying that interesting idea to you. I'd be interested to hear what you think about it. It means that the 18-month and the 54-month cycle trough that formed in March of 2020 was distorted because of fundamental interaction, which is something that sometimes happens. And it also raises the possibility that the trough that we are seeing forming right now could possibly be an 18-month cycle trough. So I hope that you find that interesting. I find it fascinating to consider these different possibilities. Whichever one of those possibilities turns out to be the case, we are still going to be watching the 20-day FLD to see how price reacts to the 20-day FLD. Is it going to cross above it? In which case we could well have an A category interaction and confirmation that a 20-week cycle or possibly an 18-month cycle trough is formed in the markets. Or is price going to find resistance at the level of the 20-day FLD? I should point out that volatility has increased recently. It's fairly obvious, but certainly when price came down to the FLD over here at the end of December, it dropped a little distance below the FLD before bouncing back up again. And so we need to perhaps give the FLD just a little bit of space in terms of how price interacts with it. Interaction between price and the FLD is sometimes a perfectly accurate and exact affair, but more often than not, it is approximate resistance that we are seeing as price interacts with that FLD. I do hope that you found today's market update interesting. If you have any questions, please put them in the comments below the video. I look forward to hearing from you.